Ladies and gentlemen, in today's video, we're going to go over the 3 indicators that prove a market crash is coming and the US consumer and also the global consumer is being hit hard and they do not have strong balance sheets like the mainstream media is saying. Now, these 3 markets I haven't spoken about before, but we have to pay attention to what's going on here because this is a leading indicator what's going to happen for the average US consumer. So everyone, without further ado, let's get straight into the news, the facts, and the data. Okay, everyone, now first things first, what we're going to talk about, something you may not have even thought about, is the luxuries watch market. Now, look at this chart, everyone. This is absolutely crazy. We can see, and this has happened with all luxury goods, in 2021, it was very, very hard to get a hold of these goods. We can see here on the 12th of July, the Bloomberg sub-dial watch index, the average price was around $39,000. But we can see here during 2021 and 2022, the luxury market went on a huge mania and the price ran up all the way to $60,000 because a lot of people couldn't get their hands on goods. Everybody was making money in the stock market. Everybody was making money with cryptocurrency. Their house prices were going up. So they were selling their stocks, taking a profit, splurging on luxuries. They're selling the cryptocurrency, splurging on luxuries, and they're also taking equity out of their house, or if they sold their house for a handsome profit, they would reward themselves with a nice watch. But again, look at this chart here, everyone. This looks like an absolute pump and dump. We can see here pumped and it hit a peak in February 2022 of around $60,000, and now it has crashed massively and has fallen down to today in early July. The average price is around $36,000. So that's right, everyone. On average, the luxury watch market has crashed 40%. And it was quite funny when I saw a lot of people talk about watches in 2021 and 2022, how they were such a great investment and you could go and buy a Rolex and it'll double in value over the next year. No, people, this was a very abnormal time in history because people couldn't get these goods. And also what I'm starting to see a trend in the luxuries market, what a lot of people are doing is they're using them for social media. They'll go ahead and buy these Rolexes, and normally when you'd buy something, you would just show it off with your neighbors, with your family and friends. But no, when you buy something now, people are called, it's called flex culture now. They're flexing on people, not just their neighbors, not just their family, not just their friends, but the whole world. Now, we'll have a look at some of the pieces that have fallen the most, and then we'll go over our other 2 indicators that show it's not just the rich assets that are getting hurt, but also the poor and middle class are getting hit as well. Okay, the piece that has fallen the most, according to this Bloomberg sub-dial watch index, is the Audemars Piguet Royal Oak Jumbo Ultra Thin, to be specific. That's fallen down 31.9% over the past 12 months, but it's still going to set you back a handsome $70,000. The Patek Philippe Nautilus travel time is down 28.3% over the past 12 months, and it'll still set you back a massive $129,000. But let's get down to some of the more middle range luxury watches. That's right, middle range and entry level watches are still very expensive. The Rolex Daytona White Gold down 23% to $36,000. But again, some of the more entry level, which again still crazy. This is entry level, $19,000 for a Rolex Sky Dweller. That's down 18% over the past 12 months. And remember, this is 12 months, is down more over the past 2 years. Rolex Submariner Date Kermit down 18% to $15,000, and the list goes on and on. But I know what you may be thinking, look, I don't care about luxury watches, I'll never be able to afford one. Well, let's go ahead and have a look at our next indicator with what's happening with pawn shops. So look at this, everyone. Something just snapped for the average US consumer. Consumers panic search pawn shops near me. So look at this chart here, everyone. We can see it spiked around 2019 and 2020, and then it flatlined, and now it is starting to spike again, showing that the average US consumer is in big, big trouble. So listen to this. The search trend spiked to a record high at the start of July and is an ominous sign that the consumer might be pawning items or selling things that were possibly brought during COVID boom to raise quick money amid the worst inflation storm in a generation. So that's exactly right, everyone. While the mainstream media and the people at these central banks are trying to tell you that the average consumer is strong, no, they're not strong. Record inflation is making the cost of living unbearable. Just to exist now, just to live, not to, go out there and spend and have a good time, just to pay your rent, your groceries, your utility bills is becoming very, very difficult. Now, interest in the search trend is nationwide, but some of the most interest is in the deep south. So perhaps, unlike Biden is trying to say, Bidenomics isn't working. Consumers who've endured more than 2 years of negative real wage growth while depleting savings and racking up record amounts of credit card debt in the highest interest rate environment in a generation are tapping new lifelines by panic selling items for cash. So that's right as well, everyone. What are the bankers and the people people on Wall Street saying, look at these greedy workers asking for a pay rise. How dare they? They're all to blame for all this record inflation we're facing. Nobody's blaming the central banks for printing record amounts of money, increasing the money supply by 50% in 1 year. Nobody's blaming the central banks for keeping interest rates at zero when they should have been lifting interest rates. And if you look at the average CEO salary, it used to be 20 times the average worker's salary, when now it is nearly 400 times the average worker's salary. So while the workers are struggling, the CEOs are getting record pay rises, and they're gaslighting you and telling you you don't deserve a pay rise and you're the reason why this inflation is still rising. And so again, what have we seen lately? People's savings has been dwindling. They've been taking on record amounts of credit card debt, but eventually your savings gets depleted and you reach your credit limit with credit cards. So the last option people have is go and sell their goods or go to a pawn shop. They may, give their new Rolex that they brought and lost 30% in value on. They may take that to a pawn shop and get a loan against that in order to try to keep going. Unfortunately, people, this is a recipe for disaster. This could be more evidence that consumers cracking. Companies such as Cheerios maker General Mills and Walgreens Boots Alliance have recently warned about a weakening consumer. Goldman Sachs told clients last month something is not quite adding up on the consumer, and asked, have we just run out of excess savings and we are returning to replenishing savings? Well, maybe the reason something doesn't add up is because they are completely wrong. Now, something else that doesn't add up, this is a big head scratcher. We saw the ADP jobs report yesterday came in at a boom, more than double expectations of 497,000 jobs. But then we got the BLS report, meaning the big lie report and statistics, and that came out and said there actually was only 209,000 jobs created, below expectations. So try to figure that one out, everybody. So look at this, everyone. The BLS jobs report falls way short of stellar ADP expectation. Because of the annual benchmark revisions, the way the BLS reports revisions, and the relatively small sample sizes of monthly jobs reports, we cannot with strong confidence suggest these reports portray an accurate picture of either jobs or employment. And I completely agree, everyone. There's a saying, there's lies, damn lies, and then their statistics. These latest jobs reports are a complete joke, and I think this proves that Bidenomics are not working. Because what you have to know is there's roughly 266 million people in the US, there's 160 million people working. That leaves 106 million people's working age over 18 are not working. Now, of course, some of these people won't be able to work, some of these people will be retired, but the real unemployment rate is much higher than they're reporting. So everyone, I know you're thinking, well, okay, what do all these economic indicators mean for you in simple terms? Well, what this simply means is, everybody, all consumers from the poor to the super rich, they're tightening their pockets. People aren't spending on luxury goods anymore because they know tough times are coming. People have run out of the savings, they've maxed out their credit cards, and now they're having to sell things to keep on going. And unlike the latest economic data we've got isn't reporting accurate picture, the jobs market isn't as strong as most people leading on. Now, hey, if you're wanting to learn how to build wealth and get ahead during these hard times that will be coming, learn how to build wealth and master the cycles of gold, silver, and Bitcoin to hedge yourself against a downside and also a market melt up, you can click the link in the description below. My course is 50% off right now. Once the course is finished, the price will be doubling. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.